The last time these exact signals appeared in the gold and silver markets, most people ignored them and then watched their portfolios get cut in half within months. Right now, in 2026, those same signals are lighting up again, and the data is too specific and too consistent to dismiss as coincidence. If you own gold or silver, or you've been thinking about buying either metal, what you're about to hear could be the most important market update you've watched all year. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. To understand what's happening in gold and silver right now, you have to go back to 2008, not just to the crash itself, but to the 12 months that led up to it. Because the crash didn't happen overnight. It built slowly, quietly, in ways that most everyday investors didn't notice until it was far too late to protect themselves. In early 2008, gold was trading around $920 an ounce. It had been on a powerful multi-year bull run, driven by a weakening dollar, rising inflation fears, and a global appetite for safe haven assets. Investors felt confident. The momentum felt unstoppable. And then, between March and October of 2008, gold dropped nearly 30% from its peak. Silver was hit even harder, falling over 50% from its March 2008 high of around $20 an ounce, all the way down to roughly $9 by October of that same year. That wasn't a dip, that was a destruction event. And it happened to an asset that people believed was completely safe. Now here's what most people never understood about that collapse. It wasn't driven by a sudden loss of faith in gold or silver as stores of value. The fundamentals of precious metals didn't change. What changed was liquidity. When the financial system started cracking in 2008, institutional investors, hedge funds, banks, large asset managers, were forced to sell whatever they could sell quickly to cover their losses elsewhere. Gold and silver were liquid. Stocks in certain sectors weren't. Real estate certainly wasn't. So the institutions sold metals first, in massive volumes, and prices cratered not because gold and silver were suddenly bad investments, but because the system needed cash, and metals were the easiest thing to convert. That is the single most misunderstood dynamic from 2008, and it is critically relevant to what is happening right now in 2026. What makes 2026 so important is the combination of factors that have converged at the same time. Coming out of 2025, gold had already broken through the $3,000 per ounce barrier for the first time in history, a milestone that grabbed headlines but also raised serious questions about sustainability. Silver, despite its strong industrial demand fundamentals, continued to lag behind gold in a way that has stretched the gold-to-silver ratio to historically extreme levels. That ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, pushed well above 80 and at certain points approached 90 during 2025. Historically, when this ratio reaches these extremes, one of two things happens with very little exception. Silver catches up dramatically to gold, or both metals correct sharply together. The data entering 2026 suggests the second scenario deserves far more serious consideration than most retail investors are giving it. The broader macroeconomic backdrop entering 2026 is one of genuine uncertainty. Inflation, while no longer at its 2022 peak levels, has proven far more stubborn and persistent than central banks projected. The Federal Reserve's policy path has been anything but straightforward, with rate decisions continuing to send mixed signals to markets that are desperately looking for clarity. Global debt levels, sovereign, corporate, and consumer, have reached levels that have no real historical precedent in the modern financial era. The United States national debt has crossed $36 trillion and continues to climb at a pace that is mathematically unsustainable over any reasonable long-term horizon. These are not abstract concerns for economists to debate in academic journals. These are real structural pressures that are actively reshaping how sophisticated investors think about capital preservation and where they choose to store long-term wealth. The Commitment of Traders Report, a weekly publication from the CFTC that tracks how different categories of market participants are positioned in futures markets, has been showing a buildup of speculative long positions in gold that mirrors what was seen in early 2008 and again in 2011, the last time gold experienced a multi-year correction that ultimately wiped out nearly 45% of its value over 3 years. When speculative positioning becomes this crowded on one side of a trade, markets become structurally fragile. Every new seller has fewer willing buyers to absorb the pressure. A single significant catalyst, a surprise Federal Reserve decision, a major credit event, a sudden geopolitical development, can trigger a cascade of forced selling that pulls prices down far faster than most retail investors have any ability to react to. There is also the dollar dynamic that cannot be ignored when analyzing precious metals in 2026. One of the most counterintuitive truths about gold and silver is that their short-term price movements are heavily influenced by the direction of the US dollar index. When the dollar strengthens sharply, as it did in 2008 when global investors fled into dollar-denominated assets during peak crisis, gold and silver prices tend to fall in dollar terms, even when their underlying value as hard assets remains completely intact. Currency markets entering 2026 are showing elevated volatility, and the dollar's trajectory over the next 12 months is genuinely uncertain in ways that create real risk for metals holders who are not thinking carefully about this relationship. A surprise dollar rally, triggered by any number of plausible global financial stress scenarios, could create exactly the kind of sudden downward pressure on metals prices that catches unprepared investors completely off guard and forces panic decisions at exactly the wrong moment. What does this mean for where gold and silver prices could realistically go through the remainder of 2026? If a meaningful correction occurs, and the weight of current data suggests the probability is significant, gold could realistically pull back into a range between $2,400 and $2,700 per ounce, depending on the severity of whatever triggers the move and how long institutional selling pressure persists. Silver, which is more volatile and more thinly traded than gold, could see even more dramatic percentage declines before finding a genuine and sustainable floor. For investors who have been watching from the sidelines and waiting for a realistic entry point into precious metals, a correction of this nature would not be a catastrophe. It would be an opportunity, but only for those who understand what they are buying, why they are buying it, and have the financial and emotional preparation to act when fear is at its highest. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money. Because the story of gold and silver in 2026 is not simply a story about price levels and technical charts. It is a story about the deeper structure of the global financial system, about where institutional trust is being quietly repositioned, and about a transformation in how sovereign nations are thinking about monetary reserves that carries implications most everyday investors have never seriously considered. Central banks around the world have been accumulating gold at a pace that has not been seen since the early 1970s, when the United States officially ended the dollar's direct convertibility to gold under President Nixon, a moment that fundamentally restructured the entire global monetary system overnight. In 2023, global central banks purchased over 1,037 metric tons of gold. In 2024 and continuing into 2025, that pace of accumulation remained at historically elevated levels. Countries including China, India, Poland, Turkey, and multiple Gulf state nations have been steadily building their physical gold reserves while simultaneously reducing their holdings of U.S. Treasury bonds. A combination of moves that represents a quiet but profound shift in how these governments view long-term monetary risk. This is not speculation or conspiracy. This is documented, publicly reported, verifiable behavior by sovereign governments that collectively manage trillions of dollars in national reserves. What makes this central bank buying trend so deeply significant is the nature of who is doing the buying. Central banks are not traders looking for short-term profits. They do not buy gold because they read a bullish forecast or because gold is trending on social media. They buy gold because their economists, their risk managers, and their long-term strategists have concluded that holding hard assets is a more prudent long-term position than continuing to accumulate paper claims on a financial system that is showing meaningful structural stress. When the institutions responsible for protecting an entire nation's financial stability make that kind of deliberate, sustained, multi-year commitment to hard assets, it is a signal that deserves far more attention than it typically receives in mainstream financial media. Here is the counterintuitive truth that very few voices in the financial space are willing to state plainly and directly. The precious metals bull market that carried gold above $3,000 per ounce was not primarily driven by retail investor enthusiasm or speculative momentum trading, the way that previous metals cycles were. It was driven in significant part by sovereign accumulation, by governments and central banks buying physical metal and removing it from available market supply at the same time that global demand was rising across multiple categories. This creates a fundamentally different market structure than what existed in 2008 or 2011. It means that even if a sharp short-term correction occurs, and the signals suggest one is possible, the structural floor beneath gold prices is meaningfully higher than historical correction models alone would suggest. Silver's situation entering 2026 is more layered, and in many ways more compelling than gold's, precisely because it sits at the intersection of two completely different demand stories. On one hand, silver carries all of the monetary and safe haven characteristics that make gold attractive as a store of value. On the other hand, silver has massive and rapidly growing industrial demand that gold simply does not have. Solar panel manufacturing is consuming silver at record rates as the global energy transition accelerates. Electric vehicle production, semiconductor fabrication, advanced medical equipment, and 5G infrastructure build-out all require silver in quantities that are growing year over year with no sign of slowing. The Silver Institute's data consistently shows that global industrial silver demand has been setting new records, and the projections for 2026 and 2027 show continued growth that the current mining supply base is genuinely not equipped to meet. New silver mine development is slow, expensive, and increasingly constrained by both geological and regulatory factors. Most silver is actually produced as a byproduct of mining other metals like copper, zinc, and lead, meaning that silver supply is partially hostage to the economics of entirely different commodity markets. This supply structure makes silver uniquely vulnerable to demand shocks in a way that creates potential for dramatic price moves in either direction. In the short term, if financial stress triggers a broad risk-off sell-off, silver could fall sharply and quickly. But in the medium to long term, the supply-demand math for silver is as favorable as it has been at any point in recent memory, and the investors who understand that distinction are the ones positioned to benefit from whatever volatility comes next. The tension between silver's short-term vulnerability and its long-term fundamental strength is exactly the kind of dynamic that creates genuine opportunity for patient, informed investors, and genuine danger for reactive, emotional ones. In March of 2020, silver dropped nearly 35% in a matter of weeks as pandemic-related panic triggered a broad liquidation of risk assets. Within months, it had not only recovered, but gone on to reach multi-year highs. The investors who bought during that panic were not lucky. They understood what they owned, they had a plan, and they executed it when everyone else was selling in fear. That same dynamic could easily play out again through the remainder of 2026, and preparation right now is what separates the investors who will benefit from those who will simply survive. The transition from understanding the problem to building a real response to it is where most financial content fails people. Information without application is just entertainment. What matters now is translating everything covered so far into a clear, actionable framework that you can actually use, starting today, regardless of how much capital you have available or where you currently stand in your investing journey. So let's bring everything together into something genuinely useful. The signals are real. The parallels to past correction cycles are specific and documented. The structural case for precious metals over the long term has never been better supported by data. But none of that helps you if you don't have a clear plan for how to position yourself intelligently through whatever comes next. There are 3 specific steps that any investor, at any level of experience or capital, can take right now to protect themselves and position for opportunity. The first step is to conduct an honest, unemotional assessment of your current precious metals exposure relative to your overall portfolio. Most serious long-term financial frameworks suggest somewhere between 5 and 15% allocation to hard assets like gold and silver as a hedge against monetary debasement and systemic financial risk. If your current allocation is significantly above that range, you may be carrying more short-term volatility risk than your financial situation can comfortably absorb if a meaningful correction unfolds. If your allocation is significantly below that range, or at zero, you may be inadequately protected against the long-term purchasing power erosion that sovereign debt levels and central bank monetary policy are quietly engineering in the background. Neither extreme serves your long-term financial health. A deliberate, proportional allocation that reflects both your risk tolerance and your time horizon is not a passive default. It is an active, intentional choice that you need to make consciously. The second step is to understand the critical difference between physical precious metals and paper-based metals exposure, and to make a deliberate, informed decision about how much of each you actually want to hold. Physical gold and silver, coins, bars, and allocated storage accounts held in your name behave very differently from ETFs, futures contracts, and mining stocks during periods of genuine financial stress. Paper instruments can be sold off aggressively, even when physical demand for the underlying metal is rising. Futures positions can be subject to forced liquidation at exactly the worst moments. Physical metal that you hold directly cannot be margin called. It cannot be hypothecated or lent out without your knowledge. It exists independently of any counterparty's financial health. If a meaningful portion of your metals exposure is currently in paper form, understanding that distinction fully and deciding intentionally how much of each form you want is a fundamental part of managing your risk correctly in this environment. The third step is to build a written buying plan right now, before any correction happens, that removes emotion from the equation entirely. Decide in advance what price levels would trigger you to add to your position. Decide how much capital you would deploy at each level. Decide what your target allocation looks like when the market stabilizes. Investors who make these decisions during calm periods execute them calmly when markets are turbulent. Investors who have no pre-committed plan make their most important financial decisions under maximum pressure and maximum fear, which is consistently the worst possible conditions for sound judgment. Write the plan down, put it somewhere visible, commit to it now so that when volatility arrives, your response is already decided and you are not improvising under stress. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The financial media ecosystem is built to keep you reactive, emotional, and perpetually chasing whatever is moving right now. The investors who build real, lasting wealth do the opposite. They think in years and decades. They make decisions based on fundamentals rather than headlines, and they treat market volatility as a tool rather than a threat. That shift in perspective is not complicated, but it is genuinely rare, and developing it is worth far more to your long-term financial future than any single trade or timing decision you will ever make. The affordability question for the remainder of 2026 and into 2027 is one that deserves a clear, direct answer. If gold corrects into the $2,400 to $2,700 range that current technical and fundamental analysis supports as a realistic scenario, that represents a meaningful discount from recent highs on an asset with a multi-thousand-year track record of preserving purchasing power. If silver pulls back toward the $22 to $30 range during a broader risk-off event, that represents an entry point into a metal with documented, growing industrial demand and constrained supply that makes its long-term fundamental case genuinely compelling. These are not guarantees. No honest analyst offers guarantees in financial markets, but they are well-reasoned, data-supported scenarios that reward the investors who are prepared for them and punish the ones who are not. Every major fiat currency in recorded history has eventually lost significant value relative to hard assets. The dollar has lost over 97% of its purchasing power since 1913. Gold has not. Silver has not. History does not repeat identically, but across centuries and across vastly different economic systems and political environments, the pattern of hard assets preserving value while paper currencies erode is one of the most consistent and well-documented phenomena in all of financial history. Understanding that pattern, respecting it, and positioning yourself accordingly is not pessimism. It is preparation. And preparation, executed calmly and intelligently, is the foundation of every successful long-term financial outcome. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.